We're here with Frank Holmes, Chief Investment Officer of US Global. Frank, there's something I really want to talk to you about, is this whole passive ETF, passive flows. Pretty much since 2008, the greatest money flow trade has been go passive. So we've seen the SPY, the largest ETF in the US for tracking the S&P 500. All these ETFs that track the biggest indices have attracted enormous amounts of money at the expense of active management. Can that be sustained in the long term? Where does active management fit in all of this?
Well, I think active management is critical in all of this. We would never have discovered high blockchain without being active thinkers. And having new mining companies and new technology companies, you need to have active thinkers. And now we're seeing Fidelity's coming out in the US with no commission trading indexes. And if you compare the equally weighted S&P 500 to the market cap weighted one, over 10 years, equally weighted far outperforms. And for the past 1, 3, and 5 years, the market cap one because of the FANG stocks. Well, if you don't have FANG stocks, you underperform. If you have FANG stocks, you overperform. Guess what? You need to have someone active that's helping pivot and make those decisions. So I think this is very important for the creation of new companies and for just managing all these indices, that active management will never go out of style. Right. But there's a big pressure on fees, there's a big pressure, and I think it's also regulations. They've had a big impact on the number of IPOs. We had a 50% drop in the US. Now there's a pushback on Sarbanes-Oxley, there's a pushback on all these regs in the US. Maybe this will open up small cap stocks. And I'm bullish because of it, because small cap stocks have hit 52-week highs.
Oh, really?
In the US. So we have something with all the negative news. Actually, the Wisdom of Crowds book really highlights something's happening that's very positive and constructive for small cap and mid cap stocks. So I think you want to stay tuned to that. And the best way to participate is with active managers, but have this uniqueness that you have. This is called quantamentals. So you apply the quant tools to look at the fundamentals and to look for opportunity and risk. And at the same time, you trade with statistical models, algorithms of, say, overbought, oversold. That's the new active manager, those who are quantamentalists.
That's right, and we're very proud of our process. We think it actually helps us uncover those under-researched, undercover, under-marketed companies that have phenomenal business models, phenomenal financials, and growth prospects ahead of them, and we like to invest in those.
So Sam, you know, one of the real important parts about Galileo and why I became a major investment in the company is betting on their concept of small and mid cap stocks. That's been the value approach. The Warren Buffett in this small macro cap, they call SMID, small and mid cap stocks, and your expertise of young blood coming in and being an active manager. So I remain very bullish on what Galileo's footprint is, and at the same time knowing cryptocurrency and blockchain, but really understanding small and mid cap. That over all long-term studies is where you make the bigger returns. There's greater volatility, but there's greater wealth creation.
Thank you. And I do believe that investment model we have is highly uncorrelated to the passive exposure. Passive exposure tends to be consolidated at the top. We are consolidated small and mid caps. We do the quantamental research that allows us to uncover under-researched, under-marketed companies. And those are the companies that we want to support. Very, very solid companies in terms of fundamentals. We look at the quantitative metrics, obviously, but also companies that give you that sort of like differentiation angle versus the major passive ETFs and that kind of exposure that a lot of investors currently are invested in.